Now it's time to bring in our first guest, a great friend of the income generation, Jon Najarian. Jon is an options trader and co-founder of MarketRebellion.com. Jon's also the co-author of the book, Follow the Smart Money. Jon, it's great to have you back here on the Income Generation.
Dave, thank you. Jeff, great to be with you both.
Hey, great to see you again, Jon. Want to keep the dialogue open here on what's happening with the markets right now and for the rest of 2021. It seems like we are in the massive MMT mode, more money today. That's part of what's fueling this rally. When do we see the money supply start to contract or the Fed start to taper, which will ultimately affect the markets?
That's, of course, the trillion-dollar question, or several trillion-dollar question, Jeff. And instead of modern monetary theory, I like your definition of MMT more. But I think the Fed is going to have to start addressing this before the end of the year with a tapering, but not with tightening. I don't think that tightening happens for quite a while. And depending on what happens with the tax bill, Jeff, that'll have a little, believe it or not, that helps the Fed, because and I'm hoping that they don't increase taxes as dramatically as they've said. I know Joe Manchin's against it, the senator from West Virginia. He's about, moving corporate taxes up a little to like 25, not to 28 or 30 like the administration wanted, and or that millionaires tax on capital gains. I think any of those things do moderate growth, even though we're going to get a spike in the short term for demand because of all the money that's been given out. So my answer to you, Jeff, is that we're going to probably see that tapering in the fourth quarter of this year, but no tightening, because I think that'll be taken care of by what happens with or without the tax increases.
So, Jon, it sounds like you're in the camp of inflation being more transitory right now and not really permanent in the long term. Am I hearing you correctly?
You are, sir. I think that's well said, Dave. I think how long lasting this inflation will be is going to be, basically how long does the government spigot stay wide open? I was just on a flight out to California, and the plane was packed, not with business travelers, as you guys have both been reporting. It's mainly leisure that are getting on these planes. And I got to believe a lot of those folks were flying with stimulus dollars. They're going to Vegas, they're going to California and Florida. Great. But when that spigot gets turned off, it'll go back to normal. And I think that's that transient, or, that temporary move up in inflation that you just addressed.
Yeah, and when supply chains get put back together properly in some of the areas where they're still fractured, that should help us out a lot too. We're going to be talking more with Jon Najarian right after the break. And later in the show, we'll take a closer look at what's happened this year in the bond market and what it could mean for you. You're watching The Income Generation, and we'll be right back.
Hey, welcome back to The Income Generation. I'm here with David Scranton and our special friend and repeat guest, Jon Najarian. Jon, great to have you back. Thank you for the dialogue.
Thank you, Jeff.
So, Jon, listen, we find ourselves in a position now where history always seems to repeat itself. But the biggest lesson of history is people don't seem to learn from it. We've seen this script in this movie before, as we have record levels of debt. When does this become an issue? Does it ever become an issue? Does the debt just keep expanding and it's something we have to learn to accept?
Well, unfortunately, yes, is the answer. We're going to have to accept it. I don't see us just dismissing it. I think when the interest rates do start moving up, which we covered already, when that starts happening, then it becomes more incumbent on the government to either rein in some of the spending or increase taxes, which they love to do anyway. They love to do both of those two things, because you get reelected giving away money, and you are appealing to one side of the Democratic Party when you increase taxes. Obviously, I don't think you'll get a single Republican vote on that increasing taxes part, but sooner or later, yeah, the bill does come due and you got to pay the piper. And that's something that we all worry about. The debt has increased so dramatically since 2008. and it's just on a collision course with bad news if we have significantly higher rates. If the rates moderate, and if we get up to 2 for the 10-year and maybe even 2.5 next year, that's okay. But if we go blow through 2 this year and are on our way to 3 or 4, which is where we were before the crisis, that's a really bad thing because that debt load is enormous and it gets heavier with higher interest rates.
Oh, that is such a good point, John. I mean, if rates go up with the debt load that it's at, it's going to be really hard to service. We're going to have problems. However, do you see rates being increased by the Fed or just going up organically because of the consumer demand and the economic expansion? Tell us how you feel about that.
I think it goes up at first because of the latter, that consumer demand, not because of the Fed, because of actual supply and demand, just as the three of us always talk about. Those are things that move the market. If you have more demand and less supply, you're going to move rates up. And I think that will happen. But then I think the rest of the world will respond to it as they've started to anyway, I guess, Jeff, because you've seen a lot of euro dollar investments, a lot of yen, of course, investments convert over into our bonds. Why? Because they're paying a yield that is significantly higher than what they can get over in those countries. And if they've got negative rates over there and they're able to come over here to ours and get nearly 150 to $2 or to 2%, which is where the 10% that 10-year is moving towards that 2% target, that's where I think you get the money flow that kind of holds the bonds back from otherwise going significantly higher, because the more bonds they buy, the rate moves down. So I think that's a moderating mechanism.
1 or 2% is always better than nothing, right? It's that simple. I've got to ask you though, when you were with us last time in January, you said, okay, buy the dips, but don't get sucked in necessarily to a 2% dip. Wait to something closer to a 10% dip, and you thought that would be a better buying opportunity sometime later in the year. Are you still thinking that way?
Yeah, I am. And you've heard analysts like Tony Dwyer over at Canaccord and others make that kind of statement. Everybody's kind of looking for what is going to kick us into the next corrective phase. We've had a couple very short corrections this year. I think we'll get one. We seem to get it every year of about 10 to 15%. Will I be surprised if that happens? No. I guess one of the outliers could be that the banks, which have been such an outperformer this year, if they softened up, that could be one of the catalysts. But it certainly doesn't seem like tech is going to be that softening mechanism, because those Microsoft earnings were great. We're going to be getting these Apple earnings, and I suspect that they're also going to be pretty darn good. So I'm thinking that the banks could be that soft spot, Dave.
Yeah, for tech to be the soft spot, we'd have to have a real spike in interest rates, but we certainly don't want that, like we discussed. So John, thanks so much for being back with us today on the Income Generation.
Thank you. Take care, guys.